right, welcome back to week 4, I think it is, of the GRA market update series. And I welcome this evening Kris Pedersen from Kris Pedersen Mortgages. So this evening's all about finance, and Kris is going to be taking us through what's going on. I've got a bit of an agenda here for you. So Kris is going to go through his expectation of interest rates, what's happening with LVRs and DTIs, and pretty much go through the regulatory change that has happened with CCCFA and talk about what he expects will happen with government, with the change of government, and what that will do with the Reserve Bank. So for those of you that don't know Kris Pedersen, he's a very long-standing alliance partner of GRA, an exceptionally experienced finance broker specialising in investment banking. And Kris has been 16 years with KPM, and I would say, Kris, I've known you for probably 14 of those 16 years. You know, you've been assisting GRA clients for most of that period. So I'll hand over to you and welcome you, and just say that Kris is somebody that we implicitly trust at GRA. He has a wealth of experience and knowledge, and I'm sure that he'll give you a good overview of what's happening in New Zealand finance. So, Kris, welcome.
So, as Matt said, been around for a while. It was actually quite interesting. Last week I was talking in Hastings, and it kind of brings me back to memories about how everything started up. And in Hastings, back prior to the GFC, when I just before I set KPM up, I remember how easy lending was. Effectively, if you had a pulse, you could get money. There was a small bank down there called Hastings Building Society. And for those of you who have been around the traps for a little bit, you'll understand that the banks lend on the lower purchase price or valuation. I remember back then we managed to get this building society to lend 80% of valuation, and they were effectively pricing everything at kind of, you know, around the same interest rates as the banks. So I remember still picking up a property for, it was in Auckland for 221k from memory, which is actually nuts when you think about Auckland pricing these days. And it valued at 275, so I had to put a total of $1,000 into it. So I suppose looking back, things have changed a lot.
The good old days. Yeah.
The good old days. And, you know, I remember going from there into, we ended up doing kind of 100% lending even through the banks. The banks would 100% finance you into investment property. I worked for a non-bank lender where we actually got up to doing 112% lending, and we may have played our part in causing the global financial crisis. We might have looked loose there looking back. Yeah. So what I'm going to do, and apologies for those who have already seen maybe development school, because I've got a couple of slides which are on that as well, but I think it's worth jumping over this because it's quite pertinent in regards to kind of where we're moving forward, to have a bit of a look back. I'm going to tell you a bit of a story. So this is Joe and Mary, and we're going to go back in time to just before we had the COVID lockdown. And if we looked at Joe and Mary back then, they had 110,000 household income, a couple of kids, owned their personal home with no mortgage on it. They had a couple of rental properties with $1 million of debt. They were renting those out for $1,000 per week combined at that stage. Their mortgages were on an interest-only basis, and the interest rate back then was 3.6%. I'm sure we'd all like an interest rate of that right now. Now, while if you jump on any bank website, they've got mortgage calculators. They don't actually work properly. We've got access to the calculators they actually use behind the scenes. And I've gone back in time and actually dragged the calculators out, I suppose, over the last few years to kind of put the story together. So this is kind of how the average bank would have looked at Joe and Mary back then. So what they would have done is take their net income into consideration, and then all the banks scale the rental. And so from a household point of view, we're talking a touch under $11,000 a month in regards to income they take into consideration. Now, in regards to the expenses, they knock out the living expenses. And what the banks do, and many of you will be aware of this, is they don't actually look at what the client or borrower is actually paying. They use test rates. So back then, the average test rate was around that kind of 6.5 or 6.65%. And even though Joe and Mary were paying their mortgages on an interest-only basis, you'll find the banks test everything on principal and interest. So still from a starting point of view, Joe and Mary are looking pretty good. They've got a touch under $11,000 of income. Take all the expenses out from a bank calculator point of view, we've got about $1,300 a month left over. So they're looking pretty good. Now, then we went into this situation where, of course, COVID happened, and I think most people will give the government a little bit of a break. The expectation was that prices were going to fall. We had a different expectation in the KPM office. We'd had businesses really started to pick up. We'd had a number of bank BDMs come in literally in the 2 to 3 weeks prior to the lockdown, apologising about turnaround times, and it was really starting to be busy. So when we went into lockdown, of course, what happened on the back of that is interest rates basically going to get pushed down. So the official cash rate got pushed to the lowest it's ever been in New Zealand. Because of the expectation of going into a recession, the Reserve Bank decided to print a whole lot of money, and that was to fund things like the wage subsidy. So initially, I suppose you can understand why they did that. And they also removed the loan-to-value rules. And that definitely had a bit of effect, in my opinion, I suppose, in regards to kind of creating kind of quasi-land banking for developers, because suddenly you had very cheap capital and you could get in with very low deposits. So we suddenly had a lot of people start to become developers because they could acquire property and the rent was covering the very low interest costs. Now, what happened on the back of that is the Reserve Bank, tipped even more stimulus on the fire. They decided to push things even further, where they started talking about taking the official cash rate negative. Now, the only reason they didn't do that is the bank's tech wouldn't allow them to do it. So they ended up giving the banks until the back end of 2020 to actually get their technology in order. And the plan was to actually drive the official cash rate below zero. Never happened, but it probably gives you a bit of an indication about what the Reserve Bank was thinking at that stage. Then they came up with what they called a funding for lending program. And this was designed that they printed the money and they were going to effectively push it through to the banks at the cash rate. So the banks were suddenly able to access very, very cheap money. And some of you who have been, suppose, buying new builds over the last couple of years may remember some of the really, really cheap products offered from ANZ and ASB over the last 2 to 3 years. So we ended up in this situation in the start of 2021 where we had these really low interest rates around kind of 2.5%. We, at the same time, started to have the banks tightening up the criteria around the rental income they would take into consideration. And that was on the back of them not knowing what to do because we went through the stage of the removal of the interest deductibility. And I suppose if we jump into looking at Joe and Mary, and what's happened in mid-2021, they're feeling pretty good about their situation because, like most Kiwis, they've had a bit of a bump in regards to their household income. And that's, of course, been because we've gone through a stage where we haven't had, people coming into the country. So the average employer is struggling to get, a hold of staff. So they've had to basically pass on pay increases to keep people happy. So household incomes have gone up. At the same time, Joe and Mary's debt is suddenly, they're paying a much lower interest rate. So household incomes have gone up. The amount they've got to pay on their mortgage has gone down. And common sense, like a lot of good investors, they sit there and go, let's go buy another rental property. And looking back to, I suppose, KPM in regards to 2021, I suppose if we look at our business prior to the changes to interest deductibility, I would say only 1 to maybe 2 out of 10 clients would have been buying new builds. That literally changed overnight when they changed the rules around the interest deductions. So pretty much immediately, everyone started to look at new builds for the obvious reason. And I would say we were probably at that stage, maybe 8 out of 10 were buying new builds. So if we now have a look at Joe and Mary in regards to how their numbers look through a calculator, we've still got their net income. It's bumped up a little bit because of the pay increases. We've got the rental income there. So they're now getting about $12,500 a month of net income coming in. The banks have taken out their living expenses, and when looking at their mortgages, the test rate has actually dropped because interest rates have dropped behind the scenes. You'll note previously they were the banks were testing around 6.65. The banks suddenly started testing, depending on the banks, in that kind of 5.5 to 6% range. So again, if we're looking at a bank calculator here, 12.5K minus the bank's version of about 11,800, we've got a pass. Banks are quite happy to throw some money out at a client like this they could add a property to their portfolio and everyone was happy. Now, if we go on almost smack on 2 years ago now, of course, what happened is inflation suddenly reared its head. And no one had really seen it happen. We hadn't seen inflation for a long time, multiple decades in regards to real proper inflation, and it kind of came out of nowhere. The Reserve Bank immediately kind of halted the printing of money, which does actually have an effect of pushing interest rates up. The 1 year rate started moving very quickly, so we went from a rate of around 2 up to about 3.5 within a very short period of time. At the same time, while this is happening, average Joe, who's a property investor, isn't really keeping much of an eye on this side of things. They're out there thinking this is a fantastic property market, property prices are flying up. We want to keep things going. So behind the scenes, there was massive demand on the banks in regards to credit, and especially in regards to the development side of the property market. Also, I suppose what was having an effect is, for those of you who were out of Auckland, is keep in mind Auckland was pretty much locked down from August through to December. We then had what was known as the Triple CFA, which was a bunch of policy wonks in Wellington who, I got told by Cameron Baggery, no one in the room had ever had any finance experience, decided to come up with some rules. And what that effectively did was made it very hard for the banks to lend money. So overnight, we went through a stage. Those rules came in on 1 December 21, and that effectively crashed bank funding and the ability for a lot of people to access cash or access lending overnight. It pushed a lot of demand onto the non-banks, and the non-banks couldn't keep up. So we had this market while probably a lot of investors thought this is a fantastic market, so they were trying to push ahead with transactions. At the same time, all of the credit was getting sucked out of the market because the interest rates are going up and the availability was disappearing because of regulation and also lack of supply in the non-bank market. So the Reserve Bank then, on the back of that, kind of engineered a bit of a property crash. Now, if we then fast forward Joe and Mary through to kind of mid-22, they've had another bump in their household income because most of you will probably remember is, at this stage here, we were still struggling to get people into the country. The $1 million loan that they initially had, the interest rates now bumped up to 5.35. The new build loans also bumped up. So they're feeling like a little bit more cash flow strapped overall. Their household income might have gone up with those payments. They're feeling the squeeze a little bit. So they decide that they want to keep their mortgages on interest only. But suddenly what happens is the banks, because they've become more regulated, say that, well, we want to push you through a full application process where you've got to apply on the current lending criteria. And if you don't meet it, we're going to force you to making principal and interest payments. Now, if you think about this, where's the common sense of this? We're going to make you apply to see if you can afford it. And if you can't afford it, we're going to make you pay more. And this gives you an idea of probably the intelligence of some of the regulators behind the scenes. So,
most banks have always done that, haven't they? Yeah. I've noticed that when their customers get distressed, they discover that there's distress, they then immediately either call a loan up and force them to sell at the worst time of the market, or they push them onto P&I and say you no longer meet our criteria to be interest only.
So I 100% agree, but I will actually defend the banks a bit this time. So I think this time it was more the regulators than the banks. Yeah. We were having talks with the banks behind the scenes, and they're sitting there going, that doesn't make sense at all. And I think part of it is that, and I'll talk about this a bit more shortly, is that in previous property cycles, we've seen the banks make stupid decisions, get themselves into trouble, and then probably maybe hurt clients a little bit on the way out. In this case here, the banks have actually had pretty solid balance sheets, and it's been the regulators rather than the banks who have actually caused these issues. Mm. So we've got an issue, I suppose. We're now sitting there with Joe and Mary, who they're wanting to retain or maintain interest-only payments. The process is, of course, they've got to go through a full application process, and as we've seen with these calculators, in this situation here, they've got an income of a touch under $13,000 a month. But the expenses have actually jumped up. And the reason the expenses have jumped up is the bank test rates jumped up significantly as the real interest rates increased. So we suddenly had a situation where Joe and Mary aren't meeting bank criteria, and we suddenly saw clients like them who were getting forced into moving from interest only to P&I. Now, to give you an idea of actually how that can hurt, if we look at basically the differences here, if you've got a couple of $1 million on a test rate of, say, 6.5%, interest only is about $11K a month. If you're forced onto principal and interest, it's about $12,500 a month. The clients who we saw got hurt more were the ones who maybe had debt for a period of time. And what was happening is that if you've got your debt for, say, $2 million on a 30-year loan term, but you've been rolling over interest-only periods, doesn't matter how long you've had the debt for, if you're only paying interest only, the monthly payments stay the same. But let's say you've got a couple of $1 million debt, you've taken out for 30 years, you've been rolling it over for interest only, you're now down to a 15-year loan term. If you're making interest only payments, it's about $11,000 a month. If you suddenly get forced onto principal and interest, you can see here it's closer to 17.5. So for people like Joe and Mary, and for lots of clients we suddenly started seeing, that's a massive payment difference. You're talking in the region of that's $80,000 a month difference across a year. At the same time, where people were having cost of living issues, other cost pressures kind of coming through, all this type of stuff, and this has kind of started putting a lot of pressure on people behind the scenes. So unfortunately, we started to see some good old Kiwi kind of borrowers and investors kind of moving down the struggle street, side of things in regards to borrowing, and a bit of commentary in regards to what we've seen in 2023. So the Reserve Bank came out with some numbers reasonably recently, and if you take the whole New Zealand mortgage market, the average interest rate right at the moment is about 5.3%. So that's taking everything, averaging it out. This is expected to continue rising, and it's expected to basically kind of peak roughly around the 6.2% in June next year. So there's still quite a bit to increase. There's still a lot of clients who are still coming off interest rates in the 3s and the 4s who are going to be making jumps up to the 6s and the 7s. Now, to give you an idea, I suppose, of actually how dramatic the interest rates have been increasing, if we look back at the GFC, we can see the Reserve Bank kind of crashed the official cash rate by just under 6%. And that was brought down aggressively to try and, save, I suppose, kind of households, stimulate the market, the general type of things that you do. What you can see here is we've almost had the same amount increased that we actually had decreased back then over the last 20 months. This is a very rapid rate of increase. What we're seeing here, this red line, is the whole time the official cash rate has been, in existence. And I suppose if we go back to the property cycle across the 2000s, you can see them increasing the kind of cash rate over time here between about 2003 through to 2008, relatively slowly. If we look at the last couple of years, this has been pushed up very aggressively. And that is going to basically mean there's going to be some pain in some household balance sheets moving forward. So there's starting to be some articles coming out about some significant percentage increase in non-performing loans. Reading between the actual numbers, though, I think it's worth saying that we're actually coming off really historic lows. And what we're looking at here is you've got all the different main banks on the left here. And I suppose what we're looking at is the total amount of loans that they actually each hold. Then what you're looking at is the total non-performing loans that they've each got up to 30 June this year. And this is the actual percentage that they've each basically carrying. 0.5% from a bank point of view at this stage of a down cycle in regards to the property market is basically nothing. If we look at BNZ, which is 0.5% there, they were 1.9% 3 years back in the middle of the COVID lockdown. So it's not that bad behind the scenes. In regards to mortgagee sales, I'm sure you'll remember the GFC, Matt. I had a bit of a look online today, and Trade Me had 34 properties for mortgagee sale. There were times in 2009 there were over 3,000 properties up for mortgagee sale at once, and in December 2008, 4.4% of all sales, so roughly 1 in 20, were mortgagee sales. So we're not looking at anything like the numbers of that we were back then.
Yeah, in the GRA client base, a lot of property investors, and there's just not much distress. There's so much liquidity, and
this is what we're seeing as well. I fully expected there to be blood on the floor. I expected it to be the best buying time we've seen since GFC. I thought those interest rates, flying up at that rate of knots. I really thought that there was going to be some like utterly amazing buys because people were going to have to offload properties. And I wouldn't say we've seen it.
No. And the banks have been pretty gentle with people that are having trouble, which you were alluding to before. So there's a degree of compassion there, but I think it's compassion for their own balance sheet, because they realise that if they push them hard in a distressed environment, that they hurt themselves as much as their customers.
Yeah, I think there's a bit of a what I'll call social contract. I think if you go back to previous property cycles, BNZ was well known around 1990, 91, when they had to get basically bailed out, and pretty much all, most of the banks are known for being, relatively harsh through the GFC on clients who weren't performing. But I think what's maybe happened since then, and also with the government to an extent maybe bailing some of the banks, well, not bailing the banks out, but helping the banks through COVID, has been there almost seems to be the social contract that the banks are expected to help people moving forward. And I just get the impression that you've got to be pretty bad or really stick your head in the sand to get mortgages sold at the moment from the banks. I had a bit of a look. We've got access to CoreLogic, which I'm sure a lot of the people online will have as well. And I was throwing all the different properties on Trade Me that were up for mortgage sale in there. And almost all of the ones that I checked have non-banks or aggressive development type funders as the lender, not the banks. I remember having a situation where it was the first mortgage sale that had hit my desk in years, a few months back. And what we'd done for a long time, if you had a client who was taking the mortgage sale who was geared or leveraged quite lowly, you'd potentially throw them over to a non-bank to buy them time so they could sell the property or properties down in an orderly fashion. And in this case here, this client was getting sold up from BNZ. I would have rang like 20 non-banks, and all of them were like, this just shouldn't happen. Banks are not mortgage selling people. So I think you'll see maybe an increase in mortgage sales, but I expect it to happen in the non-bank market, not to hear too much out of the major banks. So I suppose if there's any of you or anyone who is maybe struggling a little bit, I suppose what we would be saying is review your existing mortgages to find out where you're at. I mentioned earlier that you can jump in any of the bank websites and they've got mortgage calculators. They don't actually work properly. We can actually kind of run these numbers behind the scenes. We can show you exactly how a bank will look at you. I think it's worth anyone who is maybe feeling the pinch a little bit to run a realistic budget. You want to understand your fixed rate reviews. You want to understand if you've got rates coming off, what your payments are going to go from where they are now and what they're going to go to. Interest only expiries, I mentioned before, how large those differences can be, especially if you've got smaller remaining loan terms. Interest deductibility changes. I'm just interested to throw that at you, Matt. Are you worried about any clients who haven't got their head around maybe the additional tax that may flow through on this?
I think most clients are very much aware of it, and that's why it's such a political issue, because they're all starting to get tax bills, and they know those tax bills are going up. So there's a lot of anger in the investment community about interest deductibility. What I'm surprised about is that the test servicing rates have not been adjusted significantly to take into account the loss of cash flow that comes from interest deductibility. Have you seen the testing rates change much?
Instead of it happening on the test rates, it happened on the rental percentage that they've taken into account.
Yeah.
So we saw the banks drop significantly. So pre the change in March 21, pretty much across the board, depending on the banks, who take 75 to 80% of the rent into consideration. We saw a lot of banks drop down to 55% for a period of time.
Yeah.
We're now starting to see some of the banks separate the percentage they'll take of rent depending on whether they classify it as whether you can write the interest off or not.
Yeah, whether it's a new build or social housing, etc. Yeah.
Correct. Yeah. So some things, if you're feeling the pinch a little bit, which may help. Mentioned before about how tight the banks had been in regards to letting you go on interest only if you weren't meeting their affordability criteria. And we've started to see the banks adopt a bit more common sense approach here. Now, it's worth saying this is very much a case by case, and in some cases a bank by bank approach. But just be aware now there are situations we're seeing where you may not meet the affordability criteria, but the banks are still allowing you to extend interest only terms. Other situations we've had is that maybe you can't, roll your interest only, but you may be allowed to extend your term back out. So as I showed earlier, with a client who had, say, a 15-year principal interest term, who are able to extend that back to 30 years, that would have a massive reduction in payments. There's also maybe some regulatory exemptions coming through. Now, something we're keeping an eye on, one non-bank's already brought this out, is you might just hear moving forward something called 4AH. This was something brought in a few months ago as a recent change to the CCCFA. And it's designed to give lenders the ability to refinance existing CCCFA facilities where there can be a benefit to the client where they can access a cheaper interest rates. So you're not going to be able to use this to basically access more money. But if you're maybe stuck with a non-bank, lender on a high interest rate, you might be able to move, potentially across to a cheaper interest rate. Now, at the moment, this has only been brought up by a non-bank lender in the market. They're doing a fair few deals where they may be refinancing more expensive non-bank funding, say in 11 to 12% range. I think maybe able to move it down a few percentage points cheaper. Hopefully, over time, we might see the banks pick this up. So this is reasonably similar to a loan to value exemption. So the banks have always had the ability, if your, say your investment property is leveraged higher than what the current loan to value rules allow, as long as you're not borrowing any more money, you can go from one bank to another and it actually sits outside the rules. This is a bit of a similar type situation. So at the moment, it's only kind of seen to be an exemption on the non-bank market, as mentioned before, but keep an eye out. I'd love to see the banks get in and use this as well. So 2024 predictions and I suppose remainder of this year. I personally think we're going to start seeing sales volumes and prices to increase. You'll have your own opinions on this, Matt. ANZ brought out their most recent property focus today. And you can kind of see here, this is basically the last 3 months where we're starting to see property prices increases coming through. That's June, July, August. Tony Alexander, I've got a lot of time for because he's very good in regards to the different surveys he's done. And this is a combination with what he does and Ryan's. And you can see basically last month is really the first time we've got some confidence coming through that there's starting to be a perception of, that price, property prices may increase. You can see in the preceding month to that the sentiment has started to turn around. I think lending criteria will relax. I look at basically different discussions I've had over the last couple of weeks. I'm working with an Oz lender at the moment, so I've got a verbal approval. In this case here, this company's wanting to come into New Zealand. What I could achieve in New Zealand, I couldn't get the borrower the same amount of funds that I could get out of the lender out of Aussie. And the Aussie lender will be a bit cheaper as well. I ran home briefly today just to quickly see my son who's got a birthday today. And on the way back, I got a text from a New Zealand non-bank lender. And he said, KP, can I have a quick call as we're wanting to improve our investment product? And they're looking at the market. They've got their impressions that they think it's going to turn around. They're wanting to find ways to improve pricing and start relaxing things because they want to be kind of first in market. Another non-bank lender said to me a couple of weeks ago that his boss has said to start presenting some deals with a higher loan-to-value ratio than they've been comfortable with for a while. Pretty much right now, 2 weeks ago, Ryan, who a fair few of you will know, and myself were at a main bank function, and we were talking to the general manager of retail of one of the big 4 banks, and he said they were trying to look at ways of relaxing some of the affordability criteria as well. So I think kind of while we're in quite a tight market overall, the general kind of consensus we're starting to kind of see behind the scenes is that, lenders are trying to find ways to relax, which is positive. My concern, I suppose I do have, is this man, which of course is our Reserve Bank governor. Now, I think I've followed a fair bit of our governors over the last 20 years, and I think this man's definitely the worst we've had. I think if you look at what happened last year, Grant Robinson should never have actually rolled his term over. If we go back to National in 2017, National decided to only appoint someone for 6 months because the Reserve Bank governor shouldn't be a political appointment. So they decided to only do a 6-month appointment so that basically if there was a change in government, which of course there was, that government could basically appoint a new governor. Robertson did the complete opposite, and he decided to give Adrian Orr another 5 years. And I'll be interested to see, Matt, when you're doing the discussion with Nicola and also with David Seymour, what comes up here, because Nicola has been definitely having a fair few arguments with Adrian over the last little while. David Seymour's very much voiced that he's got no time for him.
They'll axe him. They'll axe him for sure.
Yeah, and I think in regards to, you look at kind of where we've got to with cost of living out of control, inflation spiraling, and we've had a guy who's been more focusing on things like climate change. He's been overseas talking about the Maori economy, and rather than focusing on, I suppose, what his core role's been. He's
been talking about the bank principles being based on the legend of Tane Mahuta. This true story, it sounds ridiculous, but he was explaining to a bunch of Zurich bankers that the trunk of the tree was the legislation, and the leaves was, I think he said the sap was the money that the bank printed. Yep. So he's taking a tiny little country like New Zealand, the Reserve Bank governor is virtue signalling in this woke display, rather than talking about international finance and banking. Shocking. So
I was at Jackson Hole. You can imagine him sitting around with a bunch of Reserve Bank governors, and they're discussing monetary policy and how to control inflation.
Yeah.
And Adrian Orr starts talking about a tree.
Yeah. It's Banana Republic stuff. It's crazy. Yeah. Embarrassing.
But I suppose the reason I also put him up is I am concerned about debt to incomes. It's the one thing which is, as a property investor and working with property investors, is that Robertson has given him the ability to use it as a new tool. The banks don't have the tech in order to, I suppose, enable that properly yet, but the Reserve Bank has given them until 1 April next year to be able to do this. So at the moment, the Reserve Bank is saying that they don't have any intention to use debt to incomes, but how long is it until they decide to roll it out? And I think, Matt, you and I have spoken about this previously. My view on debt to incomes is when looking overseas, and so you've got countries like England and Ireland who have used it as a tool to restrict credit. What they've done is they've only used it for borrowers who are buying their own home or own occupied property.
Yeah,
and part of it is because as a tool, it takes into account household living expenses. And if you or I go buy another investment property, we don't get another set of living expenses. Yeah. So it's a flawed tool, but Adrian Orr has made it pretty emphatic that if he rolls it out, it will also apply to investment property behind the scenes.
Yeah, and I think that's ideology, isn't it? Because they're worried about the wealth gap, and if you let investors get too much liquidity, then they get wealthy, and that creates the wealth gap. So we unfortunately have a Reserve Bank governor and a government that's driven by ideology, and I
think you can definitely see behind the scenes that you've had a government, in my opinion, definitely a Reserve Bank governor who isn't a big fan of property investors in regards to what they're trying to push through.
Until they need housing, of course, and then their other cabinet minister is imploring New Zealand to build more houses, and they don't see the link between taxing the hell out of us with interest on deductions, denying us access to finance and putting up our finance costs on one hand, which is helping with wealth gap and reducing asset values. But on the other hand, there's no incentive to build new stock because it's too risky in this environment. So, the policies are competing against each other. There's a big picture there that they don't put together, unfortunately.
Yeah, 100%. So expect more stories around business failure and forced property sales. I was reading something called the CoreLogic Pain and Gain report that they come up with in regards to where they are seeing things or where they think things will go. It's worth kind of mentioning that while you might hear about a lot of pain in regards to job losses, business failures, that doesn't necessarily mean that the housing market's not reached the bottom and maybe on the other side up. They looked at the GFC, and the general impression was that property prices had bottomed out and started to increase from about mid-2010. But it was about another 12 months after that there was still a lot of pain in regards to business failures, etc. So I think you're still going to see a lot of stories around this for the next 12 months. Interest rates to start reducing, and I'm covering the whole of 2024 in regards to when that happens. You're seeing different predictions from commentators. If I look at the bank commentators, you've got ANZ and Westpac who both think that there's a chance that the cash rate may need to be pushed up further. You've got the Kiwibank chief economist, Jared Kerr, who thinks that enough has been done, as does the Reserve Bank. And they think that there's a chance that with the amount of pain, that will be felt, that the interest rates may start dropping earlier. So it's really hard to say exactly when this starts coming through. At some stage next year, I do think we'll start to see the interest rates reducing though.
There's going to be a lot of imported inflation because our exchange rate's been dropping back. So, that's going to increase the cost of petrol and fundamentals just from that. So I just wonder whether they will adjust for that and say, well, that's got nothing to do with the heat in the economy, or whether they'll continue to push for.
They tend to look forward a couple of years, and so if they think things like that are temporary, for lack of a better way of putting it, I think they're more likely to discard those things. But you're starting to have factors like China. So obviously the Chinese economy is looking pretty wobbly, and that's going to have a pretty big hit, onto us, and also obviously Australia, which are our two largest trading partners.
On our balance of trade, yeah. Hamish asks, hi Matt and Kris, are you aware of National saying anything about removing housing affordability for the RBNZ mandate to remove an aspect of politicisation of the RBNZ? Good question. I'm not aware of it.
So I know, my understanding is both National and ACT are wanting to take it, just back to basically straight monetary policy, focusing on, I think, the 0 to 2% inflation. Oh, so the 1 to 3 is it? Inflation band, and basically removing everything else in regards to climate change, housing, unemployment, everything else. And that's where they want to simplify things and go back to where we were.
Actually, it's quite useful to have questions for the politicians like that. And of course, in my next workshop, I've got David Seymour, then I've got Nicola Willis in the subsequent one. So if you guys have got questions, feel free to drop them on here, and I'll ask the politicians your questions. And if you do attend those workshops, it'll be a chance for you to get in there and put forward your questions as well. Jill says, do you think DTIs will have a huge impact on property investors? Based on a few reports, there are very few investors that have DTIs above 7 to 1.
I would disagree with that from the clients we see. I suppose it's a case of where you are in the country is a big factor. So I would say it could have a very depressing, effect on places like Auckland, where debt to incomes are known to be considerably higher. If you're in some of the regions, you're potentially fine. I think what it does is it suddenly starts pushing a lot of borrowers into non-bank lenders, because it's the only way that they can continue to basically access money.
Joe Johnson says, based on what you're saying, rates will drop in 2024, where a loan is coming off a prior fixed rate of say 3 to 5%. Would you recommend refixing 1 to 18 months out at higher rates rather than longer term lower rates to avoid early break fees?
Yeah, we're doing most of ours in the 12 to 18 months at the moment, depending on your debt. I mean, I've got a couple of $1 million, which I'm not really looking forward to coming off in April next year. I've got a bit of an eye on, because that's going to add another $7,000 a month for me personally. So I'm trying to keep a pretty close eye on that. I think depending on your own situation, you may want to stagger it. But I definitely wouldn't be fixing too long. I had a client I was talking to a couple of days ago who basically just decided to go for the 5-year because it was the cheapest in the market. And that's the worst mistake. We saw a lot of people do this coming out of the GFC, where the longer term rates start to be cheaper. But what happens, of course, is eventually the interest rates start to drop, and the break fees are horrible getting out of these things. I mean, you must remember, Matt, some of the horrendous break fees that we saw some clients have.
Yeah. I got stuck for one as well. Brett says, with income to debt ratios not being used for new builds, how many times will the bank let you use this green card? So asks Brett. So do you know what he's talking about there with DTIs not applying to new builds? Are they? I don't think
that's been decided yet. So I think there's an expectation that because, of course, we want to build more houses, that the Reserve Bank will exempt new builds on the DTI side, just like how they've exempted new builds on the loan to value side. But the rules haven't come out, so we have to basically see what they are before I can advise you.
Mm. There's a few questions here, one from Joe and another one from Patrick here saying loans coming off shortly. What terms would you go for? And I just want to weigh in there and say, Kris, I reckon that we could have persistent high inflation as possible, and I don't think a national government would hesitate to maintain high rates and mercilessly attack inflation. They tend to be very traditional in the way they deal with inflation, and so therefore wouldn't surprise me to see rates staying persistently a bit higher. That's my personal view. And I look at and I carry a lot of debt. I've got a decent sized portfolio. And I look at the rates that you can get for 5 years at 5.99. They don't look too bad to me. Like I'm not afraid of refixing some of my debt at 5.99 because it could easily be subject to a disruptive offshore event.
Yeah, fair point. But I think it comes down to the individual borrower, how much they're carrying. And it goes back to what I said before, is that there may be benefits of staggering it around a few different times. Trying to pick the tops and bottoms of interest rate cycles is very hard to do. And so I think if you're carrying a fair bit of debt, obviously you've got a big portfolio, Matt, I'd probably agree with you there. If you can hedge over a number of different times, you only have to look at what we've gone through in the last few years. No one would ever have thought we've got a global, situation like COVID. We're coming out of COVID. No one would have thought we've gone through the situation that we have with the Russia-Ukraine. All of these things, having a detrimental effect on where interest rates are now. There's no guarantee that we come out of this seamlessly and we don't have another effect. So yeah, I definitely hear where you're coming from.
Keep going.
So a change in government will be positive for credit availability. I mentioned earlier on that the effect that the triple CFA had, and National have said they would roll back both the triple CFA, and there's also something called COFI, which is the Conduct of Financial Institutions. I won't talk about too much tonight. David Seymour, I'm a bit of a Seymour fan in regards to removing regulations in general. I'm quoting him. He said, "The others like to start by thinking of how they can spend the money you earn. I want us to start by thinking of how we can get out of your way." And I think that's a great kind of quote from a politician. And I think that gives an idea of what he would do. That would basically be great in regards to the general availability of credit. He's not going to try and regulate this as much as the current government has. So let's say you're not feeling maybe too bad on Struggle Street, you're on the other side of the street, and you want to be ready for opportunities. A lot of cases that you still, I suppose, want to review your situation. We've seen quite a few people who want to charge out there and start being in a position to buy. But I would recommend you review your situation, but before you do so. A lot of people may be kind of carrying debt, which is still to come off into higher interest rates. It may, some of their debt might be on an interest-only basis, which may be getting moved to principal interest. You want to have a good understanding of how this is going to flow through before you go take on kind of more debt. Now, I want to have a bit of a talk about the bottom right situation as well, which is releasing properties. And it's something we've seen a lot, probably over the last 12 months or so, is where banks are very, very good at grabbing as much as they can, and investors often forget to kind of get securities released when they can as well. So this is a client I've actually been speaking to over the last kind of couple of days. So looking at his situation here, you can see he's got a personal residence, 4 rental properties. Basically, the total portfolio is roughly worth about 3.2 mil. His total debt's a touch under $1 million, and ASB's got their hooks into every single thing that this guy owns. Now, looking at his situation here, what we've basically recommended is he drops out his personal residence, so the property at the top, and the investment property at the bottom. So effectively what that's going to mean is we've got these mortgages here, which could then remain, I suppose, secured against these 3 rental properties. And Matt, I suppose I'm interested in your opinion, because what we see with a lot of investors is they get confused and they often don't understand that we can do this and that basically the tax position stays the same.
Yeah, so he's got some non-deductible debt over his home. Can you just go back to the prior?
So what we've got is we've got basically a client's total position.
Yeah.
And I'm not getting into basically the entities that it's been owned with, but we've maybe got a personal home and a number of rental properties. And often what we see is basically you've got a situation like this where the bank's got the hook into the whole portfolio.
So Kris, you know what our firm would do with you guys is we would want to understand whether there's any new builds or commercial properties in that portfolio and try and understand what the tax structure is. So if it's in a company or an individual, we'll do different things. But there is the opportunity to get rollover relief, which we discussed with Anthony Lipscomb last week.
Yep.
So you could very well take that 456,000 and pin it to a new build and move it without triggering interest on deduction rules or a reset for Brightline, because you can move assets with the right structure. And then conjunctively with that, we would be working with Kris to drop out, to release securities. So, that personal residence is not required because the LVR is so low, 33%.
And that's kind of what I'm saying here is in this case, let's say, in this particular case, this client had had the properties for a long period of time. So what we decided to do is drop off his personal home and one of the rental properties. And what we're looking at is getting ASB to release security on those two, which would basically mean that the total mortgage debts are around 960K was going to be secured on these 3 rental properties. But
I want that and that's excellent advice. But the tax side of that is I want that 456,000 to become tax efficient.
Yep.
So I'm looking for places to park that's going to give a deduction.
And so I suppose what we're looking at here, of course, if we drop in those 2 securities out, the personal home and the one rental property, we're leaving ASB with a lower asset value. But then what we're looking at is with these 3 being existing long-term rental properties, the bank can leverage up to 65% of those. So we've got $1.6 million of asset times 65%. Theoretically, the bank could basically hold up to about $1.05 million. That's more than what the bank's holding. So that means it should be sufficient to drop those 2 properties out. And what we've been doing with quite a few clients is going, when you get to a stage, don't just leave, additional securities with a bank. What we've seen, especially over the last 2 to 3 years, is often what will happen is a bank will look to go sell a property. And these days, the banks will put clients through a full application process. And if you can't meet their current criteria, they will take the full proceeds and apply it to residual debt. So when you can meet basically the lending criteria, use this as a chance to drop securities out. Another quick point as well for retirement planning. Let's say we use this client as someone who's maybe nudging a bit closer to retirement. So what we've got is we've of course already dropped out their personal home and we've got this rental property all parked by itself. Something they're doing more and more is maybe kind of looking at clients' positions, understanding that they want to kind of hang on to their rental portfolio. But at some stage when they're in retirement, they're going to maybe need to get their hands on cash. And we see people as they go into retirement, they can be a long time retired, and they often end up in a situation where they're asset rich but cash poor, and so they're in a situation often the banks won't basically extend them further credit. So we try and take a long-term view of setting them up as well as possible. So in this
sorry, Kris. Thomas asks, re-releasing properties, will the banks consider serviceability in that question?
Yes, so I just want to make that really clear. But in most cases, the banks are going to put you through a full application, and if you don't meet their affordability criteria, they're going to decline it. Now, this comes down to, we've seen situations, especially over the last 12 months, because of some of the cash flow pressures we've been talking about here, where people have decided to go sell a property. They're selling a property to reduce debt, but they're also selling a property to get their hands on cash. And what's been happening is the banks are taking the full sale proceeds if they're cross-secured behind the scenes, and they're just applying it to residual debt. So what we're talking about here is a better strategy to move forward with is part one, before you could decide to go sell a property, if you cross-secured, check if you're actually going to meet affordability criteria, so you can find out whether you're going to get your hands on the money. Part two, if you're in a situation like this client was here, where you've got a lowly geared portfolio, take the opportunity, if you can meet their affordability criteria, to drop properties out when you can, because there might be a time in the future you can't. And if you can't, You don't want to be in a situation like this where they're going to take all the money.
Will the new open banking rules coming in provide competition between banks for customers?
It's going to make it, I think, a lot easier for banks to move around. It makes it a lot easier to access information, how that affects credit criteria. It's too early to say. I'm not sure there.
Patrick says he's told the current debt servicing test rates are at 9%.
Yeah.
Mm.
So what I'm looking at, I suppose, just to quickly jump through this side here, is let's say we've got the previous client, they're now in a situation where they've got this rental property which has got no hogs in it. What we also recommend, let's say you're a person who's having a listen tonight and maybe retirement is in your near future or maybe coming up in the next 10 years. You might be looking at your portfolio and going, okay, we're still planning to hang on to it for the long term. But what we generally recommend if you end up in a situation like this, you might have one property, which is maybe the one that you're most likely to sell. And often, and there's other things to take into consideration, but often that may be the property which we leave unencumbered. So if you decide to sell it, you can get your hands on the full sale proceeds. So often what we're doing is parking that one, out by itself. We are ideally structuring debt with certain banks who will allow us to structure the debt as revolving credit facilities or something similar without you having to go through a full application process. So I'm picking on ASB. ASB won't do that. If you want to turn your existing mortgages from a standard mortgage into a revolving credit, you've got to go through a full application process. Lenders like Westpac, as an example, their floating facility has the ability to redraw. So for a client here, we've set them up properly. They could have this current situation. They decide to sell it. They get their hands on the full sale proceeds. They could then convert some of the mortgage into a floating facility, but dump the money in there, but have the ability to save on the interest costs, but still access that money in the future should they need it. It's a much better position if you're going into retirement. It saves you if you're basically in the situation where you're asset rich, cash poor, but may want to access money in the future. So a bit of a quick talk on bank and mum and dad, and I won't talk too long here, Matt. It goes back to having a bit of a listen with you and Anthony last week. I think I read recently that the Bank of Mum and Dad is now the 5th biggest lender in New Zealand. It's bigger than Kiwibank. I think it's almost bigger than Kiwibank, TSB, SBS, and that kind of combined. And this is because, of course, I suppose New Zealand house prices are considered to be pretty expensive. And so there's a fair bit of family assistance, and it's pretty common, I think, these days to try and help your kids into the property market. I had a bit of a listen in regards to what you and Anthony were saying last week in regards to structuring. And we see banks, again, do a pretty good job at trying to cross-secure maybe the parent's home into the kid's home. And often, some of the way it's structured is definitely not advantageous for either party moving forward. I still remember a horrible story. I was actually working on your floor, probably it might have actually been around the GFC, and a lawyer got in contact with me, and you had some lovely lady who was a nurse, and her property had almost been paid off. And she decided to try and help her son into a property. She did so, and he then went and got a P addiction, and he ended up in Mount Eden prison. And BNZ ended up kind of coming after her property. And it was, that BNZ done a great job at that stage of looking after them, but it was a completely wrong structure for the client. Any comments you'd make from what you've seen in regards to structuring this type of stuff correctly?
Well, wouldn't Triple CFA take care of that these days? I think they're pretty front-footed about
some of it does,
persons,
other parts don't, because we still see situations. So what one of the big things is that you won't just have a bank taking someone on as a guarantor. They'll generally want someone to be a co-borrower and probably seen to have some benefit in the property. That doesn't necessarily mean that there isn't risk in, if it's not structured correctly. So we're still trying to, I suppose, minimize the exposure to the parental property, and you're also trying to set the kids up that they can maybe stand on their own feet as soon as possible.
I have had some dealings with banks over that, and I've found them to be quite front-footed on what they would describe as a vulnerable person.
Yep.
And I think that the last thing they want is to be dragged through the media as having aided and abetted a situation where, a parent ends up on the street. So I think the banks do a pretty good job in New Zealand on that front.
I think there's other things that we'd say, which are things like deed of debt. you'll see a lot of situations where, again, I suppose mum and dad might want to help their kids into a property, but wouldn't be recommending that you necessarily just gift the money across, because I suppose these days we see what more than 50% of relationships dissolve. And so you want to make sure that you're using the right documentation. So if the relationship does fall apart, you are kind of covering your bases there.
Yeah. I mean, springboard loans, Westpac were doing them, weren't they?
Yeah.
Where you could draw 20% of your parents' property, and then Westpac would advance 80% of the subject property that the kids were buying. And that's the way to do it, is to not have the parents guarantee the full loan, and to not use the parents' property as the full security for the loan for the new property.
That's a good point.
20%.
Yeah. So it's something we wrote this One Bank Trap ebook a little while ago now. You've got a couple of chapters in there, Matt, so I plagiarised all the stuff off you probably a good decade ago. It's probably worth saying is that right now is a pretty good time if you are looking at doing any restructuring. Matt mentioned before a few of the reasons why you might look at doing it, but often when you're coming off interest rates, the best time to restructure is then. Cashbacks, a lot of you will understand what I'm talking about, but it's become pretty common these days that if you're moving from one bank to another, the bank will throw out a pretty aggressive cash contribution. That's one of the few times you can get some reasonable money out of a bank for doing very little. And we recommend that if you are doing some restructuring work, what we try and do is go from, say, existing bank to new bank at the same time as you may be going from your existing structuring situation into the new one. And that minimises your overall conveyancing costs. And in a lot of cases, we can get maybe the new bank to cover a fair bit of that cost overall.
Actually, Kris, I'm terrible at getting money out of banks. And I deal with BNZ, and I deal with them with their commercial side directly. Why do they never give me any cash back? I should be asking for that, shouldn't I?
That's part of, you'll find it's part of the bank you're dealing with. It's one of the anomalies that's always been quite entertaining, I find, with banks, is that you think if you become a bigger, a larger, a better customer overall, that if anything, you should get a larger cashback than the average person on the street. Unfortunately, it tends to go the other way. I had one of your business partners refer a client on recently, and talking to the client, and he was throwing a whole lot of expletives out because he couldn't believe that he had been charged a fee, had received no cashback, where his most junior staff member had received this great cashback and a better interest rate than what he could get.
Yeah.
You often find that what the banks do is that you'll be able to maybe obtain levels of financing and approvals that maybe a lot of people can't. But that's because of the part part of the bank you're dealing with.
Yeah.
So a quick, I suppose, few slides in regards to if you're struggling to get the capital through the banks. I suppose if we look at KPM, we go back a few years ago, probably only 5% of what we were doing was in the non-bank market. We're probably roughly at the moment now around 30%. And so a quick couple of examples on transactions that we've done recently where we've looked at clients, ideally that we would get them through the banks. That's always going to be our first port of call. You're looking at people who can, if they've got sufficient equity and income, they're basically we're always going to, try and get them through the banks. But there's, especially over the last kind of 12, 18 months, a lot of clients and investors in particular have found it harder and harder to meet bank criteria. And so that means that we're having to basically use non-banks more and more. So this was a client of mine who basically, according to the banks, was short in income. They had a good household income of around 300K, and obviously you can see they're pretty strong with about 16 million property and only about $3.5 million of debt. Most of their debt was on good interest rates, but it was on pretty short remaining terms. And they are pretty what I call a classic counter-cyclical investor, where they could see that, I suppose, coming into this winter, prior to the election, they wanted to be in a position where they were ready to buy. Now, their debt was spread over about 4 lenders in total. This is just an example of one of the lenders. We had to do the analysis on everything, but using one lender's position, you can see all of the loans here on the left. This is the actual interest rate they were basically paying. The expiry date was 9 years away in 2032. Now, the bank was testing them at the time at 8.75. So as an example, they're taking the 40,000 you can see here. They're testing them at the 8.75 on a principal interest basis over a 9-year term, which basically meant that from a bank calculation point of view, it said they were paying $536 a month. Now, the client was actually, only paying 5.15 on interest only basis. So they're only paying in reality 172. So in the bank calculator, they're paying with that particular bank 11,500, and that's what's being they're being assessed at in regards to what they can borrow, but they are actually only paying the 3,600. So if we go back to one of these calculators, it's a bit similar to the Joe and Mary example we were giving a bit earlier. You can see here that we've got about $30,000 a month according to the banks on income, but the clients are missing affordability by about $7,500 a month, because by the time we had all the actual mortgages put through at the test rates on the remaining terms, they're missing because of how the banks are assessing it. Now, we've now got a number of non-bank lenders who, while they may assess the new debt on maybe higher test rates on a principal interest basis, they'll look at the debt they've got, the investors got elsewhere on the actual payments. So we've got the same situation here. Income figure doesn't actually change too much from a bank point of view, but the actual payments, we look here, almost 34,000. Non-bank only taking 13,000 as a monthly expense into account. We've got a situation here with the bank, they're negative 7,500. Non-bank, affordability works much better for clients in a position that they can actually move forward, and they want to be in a position where they could actually pick up another property. Huge difference, and I think we're going to see a lot more of this type of situation moving forward. You're paying a higher interest rate, but for clients who can actually pick up reasonable deals, it's a great way to move forward. Now, second case study, this is basically someone who was short on equity, so they didn't have the ability to meet the bank loan to value requirements. It's worth mentioning that the Reserve Bank relaxed the LVRs in the start of June, and so this transaction started just before then. So we had a client who's picking up a rental property for 900K. The property was needing about $100,000 renovation to get it to where they wanted. After the renovation, it was going to be worth about 1.3 million. Now, looking at their personal home, if we top their home up to 80%, that would have released 290,000. So that's the equity we could pull out of it to basically move them forward with this purchase. The issue is if we're looking at the bank requirements, we needed 40% of the 900, so 40% of 900 is 360, plus we needed the 100,000 reno, which is 460. So the bank funding would have required the client to have 460. They were only going to be access 290,000 from their home. So what we're doing is we're always going, can we basically make this work from a bank? And, short answer was no, for the reasons I've just mentioned. We had two different non-bank options. And both the non-bank options, effectively, we could make work because we could fund to 80% of the purchase price. So 20%, shall we say, that they had to put in. So 20% of 900 being 180,000. Plus 100,000 renovations is 280K. We had 290K we could pull out against their home, so we can make it work through two different options. What we're looking at here is comparing option one, option two. Now, the first option was a straight first mortgage. So 80% of the 900K purchase price at a pretty high interest rate of 11%, which may scare some of you, but stay with me. The second option was 70% of the purchase price and a 10% second mortgage. Now, cash flow was paramount for this investor because of what they were trying to do, which I'll get onto shortly. So we're comparing option one, option two, and the second option ended up being a pretty significantly lower monthly payment, saving about $1,200 a month. So that's basically the option we went with. So how do we fund this? So they bought it at 900. The client had to get it as is an on completion valuation. It only valued up at 920, and I think that's because the valuer was being lazy because they could see what the purchase price was. So they didn't look at face value to be much of a discount. So what we were doing is basically the client was putting in the 20% or 180,000. They're putting in the $100,000 for the renovation. And that combined with the original 80%, which was coming from the funder, is basically meaning there's $1 million in the deal. Now, after renovation, as mentioned previously, it's going to be worth about 1.3. So they've managed to actually create a fair bit of equity across the transaction. So what we're doing in this situation here is that while those interest rates before were looking pretty scary maybe to some of you, keep in mind that the aim is we're going to be ending up with a property worth roughly 1.3. We're only going to have a mortgage before we actually refinance this at 720. And keep in mind that we can go to a bank at 65% of market value. which is 8.45 or considerably above the mortgage debt that we've got on the property. So while those interest rates are maybe looking a little bit high, don't always be afraid of using non-bank funding, because this one here, yes, the client's going to maybe be paying a little bit in regards to fees and higher interest rates, and they're in the process of finishing off the renovation at the moment. They're going to end up basically getting refinance back to a bank, have a pretty good long-term property investment there. So that's pretty much me. I think over to some questions, Matt.
Patrick says, if National get in, how long will it take for them to reverse the interest on deduction rules? I think that is the
biggest question you're going to have.
Yeah, I mean, that's a huge question that everybody's got. And Patrick, no one knows except the National Party. It's a shame they're not a bit more transparent about it. But Paul Goldsmith did tell me after our some interaction with him in the last couple of weeks that they're going to announce it in the next couple of weeks, and there's pretty much a clear inference that it's going to be phased out. They're not going to yank it out. Whereas David Seymour says he wants it out from 1 April next year. So, you know,
I think Seymour wants to reverse as much as he can.
So say again, Kris?
I think David Seymour wants to reverse as much as he can in the first 6 months.
Yeah, he's great. So Julian says, do the non-bank lenders lend on interest-only terms too, or only P&I?
Yeah, great question, Julian. So pretty much all of them will lend on interest only. We've even had a few transactions where we've gone from bank to non-bank, even though the interest rate's higher, because the bank will want the client to stay on principal interest terms. And so the client, for cash flow reasons, has been willing to pay a higher interest rate to get interest only because it's cheaper for them. So pretty much every bank will do, every non-bank will do interest only. Most of them are seeing it as a pretty big point of difference in regards to what they can offer against the banks.
Hamish is chipping in, I guess, into the political stuff, saying, as an investor, he sees tenant selection, the RTA 2022 amendments in relation to no-cause evictions and the Tenancy Tribunal eviction cost and claims process as a larger risk than high interest rates. Well, I can tell you that both National and Act are going to repeal those changes, so that's good news. Hopefully good news. Sharon says, how can we move security out of the bank based on the example about one person who has a mortgage over all of his properties with ASB that you just showed? So what is the process, Kris, to approach the banks and try and beat them up to release?
The biggest thing, I suppose, part one is understanding, do you have enough equity? And so I suppose what we say is, from a starting point of view, is if you look at your home and you can generally lend up to 80% of the value of your home. On your rental properties, you can generally value, you can lend up to 65% of them. So you start with what that enables you to borrow up to. You take away with, whatever your existing debt is, and that will give you an idea of, do you have the equity to enable you to do that? I think what you mentioned earlier while we were going through that example, though, Matt, is pretty valid. Going, okay, are there some tax or structuring advantages that you can maybe undertake, and you should be kind of probably bringing GRA into the picture to see what you can get there. But from a financing point of view, let's say you've got the equity. Next step is basically going to the bank and seeing, do you meet their loan affordability criteria? And if you meet the affordability criteria and there's enough equity, from a bank point of view, they should let you drop those securities out. So we can run those checks for you to advise whether that should be something you can achieve or not.
Kris asks an interesting question. He says, have you had any luck accessing lending outside of New Zealand, much cheaper rates available, obviously with an exchange risk?
Personally, no. I remember, Matt, I think, sitting in your office prior to the GFC, talking to a Singapore banker that we tried briefly about 2008, if you remember.
Yeah, I had a crack at it, and I did find funding, but I was too afraid to do it because they margin call you if your exchange rate fluctuates. So I remember doing a big complicated spreadsheet saying, well, over 10 years, if you can withstand the interest rate fluctuation, the exchange rate fluctuation, you don't get margin called, so you don't end up having to inject a bunch of capital. Or if you do have the cash to inject the margin calls, then by the time you get to year 11, the interest rate differential cost, which is much lower, for example, borrowing in US dollars traditionally, pretty much funds any margin call and exchange rate fluctuations. So if you can survive the first 10 years, it works really well. But I certainly never had the courage to do it because there's a bunch of farmers that went broke doing that in was it the 80s or the 90s?
I think it was even later. I think you even had a few in the 2000s who they enabled them to do foreign currency lending, and the farmers all got bankrupted on the back of it.
Yeah, it's a disaster.
We saw a few in the GFC from ANZ. So ANZ was enabling some clients who were living in New Zealand but had properties here, especially they were often clients who were domiciled in Singapore and that, and it was pretty scary seeing some of the margin calls that came through.
Jason says, what do you suggest people do who can't refinance? What to do in this high interest rate environment?
I think it comes down to can you know, with the bank that you're at, if you're feeling the cash flow squeeze, can you basically roll interest only? Can you extend loan terms back out? If you can't do that and you've got absolutely no options at all, the banks do have hardship tax. I suppose it's a case of looking at your own situation first and going, what will you be allowed to do from the bank? If you've got no options at all, though, I wouldn't stick your head in the sand. You want to have a chat to the bank.
Lee asks, when refinancing from one bank to another, is it the mortgage broker's responsibility to find out what the original bank with existing loan requirements or with existing loan requires before releasing the mortgage to the new bank, or the client's responsibility?
So we would generally do that, yes. So that's definitely got more complicated in recent years, and that's because the discharge process has become so much more complicated. So we would generally sit there and go, part one, advise the client; part two, make sure we can give them approval. And often if you're refinancing a property from existing bank to new bank and you're maybe removing a security, we have to then get an approval from the existing bank as well. Previously, you didn't have to do that. It's become a lot more messy that you're having to get two banks involved to get it across the line. But yeah, generally, yes.
And that's why the one bank trap is such a bad thing to fall into. And if you can have all of your financing standalone, which is something I always endeavour to do, life is easy, because if you're discharging one loan in one company, despite having 10 properties, if it's standalone, then you have power over the bank. But if you're cross-security everything, it's a disaster. Max says, I thought most banks dropped the revolving credit facility, only SBS. What is he saying here?
Pretty much all banks have revolving credit facilities. They use different jargon for it. So ASBs is an Orbit, ANZ is a Flexi, BNZ is a Rapid Repay, Westpac is a choices every day. They've all got different names for it, but pretty much every bank will have a revolving credit facility. The biggest change we've seen over the last few years, I remember with how long I've worked with GRA for, is if we go back to 10 years ago, working with Celeste, who's obviously Matt's business partner and stuff, and one of the biggest ways we set property investors up was try and get massive revolving credit facilities, so you had the ability to move really quickly if you found a good deal. Those days are pretty much gone. The banks won't just give out large facilities for no reason. They want to control the where the capital, I suppose, or funds are going a lot more than what they used to. So those limits have come down a lot, but revolving credit facilities are still available.
Georgina asks, how do banks generally value property, CV or current market value?
So the most common valuation system we see is a desktop valuation. So the two main systems banks use are CoreLogic and Velocity. And so that's when they can just run a desktop valuation in-house. If you've renovated your property, that's not going to come up on a desktop valuation. And so we have situations there where we might go forward and say, okay, the client's done this, they believe the property is worth considerably more than what your desktop is. And they'll condition for you to have to get a registered valuer out to substantiate the value. It's government valuation, rateable valuation, CV isn't really used anymore as a measure. It was used a while ago. We just don't really see it anymore.
Is that the same with non-banks, non-bank lenders?
Yeah, good question. Non-banks, so that's been one of the areas where non-banks have been painful because they have for a long time, in most cases, wanted a registered valuation. They're slowly catching up with the times, and more are able to use desktop valuations up to certain loan to value ratios. Sometimes when you go over a certain limit, they are going to want a registered valuation.
Greg asks, do banks still recognise as of complete valuations as a source of equity in a deal?
Well, they're going to take it on as is valuation if that's basically where the property is, at. They'll take the on complete valuation when the work's been done.
Yeah,
So,
I mean, I fund my developments on this basis.
Yeah.
So as of complete, they're going to look at that, aren't they?
Once the work's been done.
If they believe that the developer is sufficiently skilled and the market's sufficiently buoyant that they use them, and in this tight credit environment, they're being more cautious. But I've got a deal going at the moment where they're doing that, so I can say that I'm doing it. Kris, what are you seeing as a general range of monthly living expenses going into applications for a Joe Bloggs family of 2 adults and 2 kids at present?
I think that the average family is not spending much at all, Matt. So they want to state quite a low living expense because they're feeling a bit recessionary at the moment. It's a bit hard to answer that question actually online at the moment.
Yeah. I think the question's saying, can you drive your living expenses down so that your serviceability looks better?
And yes, that does happen to an extent.
Yeah.
Yeah. So we generally sit there, and that might be part of a review to go what's realistic.
Yeah. What are your non-bank lender preferred options? So which banks do you prefer? Which non-bank lenders do you recommend?
Non-bank, it's really case by case because it comes down to why are you needing to use a non-bank? So it comes down to, for example, if it's lack of equity, we've got cases where it may have been the selects or the liberties who enable us to go to a higher loan to value ratio. It's affordability. Then you might be having someone like a first mortgage trust or we like Base Corp because they're fast. If it's more going into development, then you've got other funders you'll use. So it's really kind of coming, why are we using that non-bank as a starting point?
Where is non-bank appetite for funding on land banking and development sitting?
So it dried up quite a bit because the banks, I suppose, had shut up shop for a while. We had prices coming back significantly. I suppose a large part of the non-bank market, and the reason you use them is that they didn't need quantity surveyors, they didn't need pre-sales. And they suddenly were getting more swamped because the banks were getting pretty tight. We have seen a big part of that market be quite difficult to deal with for a while, but we're starting to see that start to free up. There's starting to be more participants kind of come back into the market. There's been an Aussie lender who's come in recently who's willing to go to slightly higher loan to value ratios. So there's definitely some options there. It's not cheap if you're wanting a fair bit of flexibility and as I said, not wanting pre-sales and stuff like this, but there's definitely funding available. We're seeing a large part of that market. Most of what they're funding is actually residual sales stock. So there's a lot of developers who have ended up with using non-banks because they haven't had to get pre-sales. They've now basically coming towards the completion of their project, and there hasn't necessarily been the buyers sitting there ready to pick the stock up. And they're maybe not wanting to basically throw the properties on the market right now. They're wanting to buy a bit more time. So a lot of those development funders have more ended up for a while funding residual stock, giving those developers maybe 6 to 12 months to sell down, maybe other side of the election when it might be a better market.
Would a lender potentially offer cash back on refixing a mortgage that has ended and gone back to floating? I'm with Westpac.
We see it every now and then. I mean, this is always going to be a behind the scenes type situation. You're never going to see the banks come out and say, we're going to throw cash backs at every single client coming off their fixed rate, because that's going to absolutely punish their balance sheet if it makes sense. So it does happen occasionally. It's definitely the exception to the rule, though.
Do the banks or non-banks take multiple flatmates, rent and board in large houses as incomes?
Yes, so the banks and the non-banks will do that. That has been an area which has actually relaxed a little bit over the last 12 or so months. So you're starting to have pretty much across the board, more of that as an income source will be taken into consideration. It definitely differs from lender to lender though.
In your opinion, what are the best non-bank lenders? I think you answered that in this situation. Yep. Does the bank normally accept your request to not have shareholders as one of the securities of the loan? So,
so is that basically saying
does the bank normally accept your request to not have shareholders as one of the securities?
Is that for one of the guarantees? I'm presuming the shareholders having to give a guarantee. Is that what that's referring to?
So Sharon, maybe I'll answer that.
Yeah.
So I'll often see clients that have trusts as shareholders in companies, and they'll say to the bank, "We'll give you the company guarantee, but you can't have the shareholder, which is the trust's guarantee." And you can do that. And if you've got a strong statement of position, then you'll be able to negotiate that with the bank. The advantage being that the other assets of the trust, for example, other companies owned by that trust, are then not at risk of that company failure that's borrowing the money. So it's prudent to do that, but you need to have the sufficient strength to be able to muscle the bank to say you can't have the shareholder guarantee, you can only have the director and the company guarantee. Any asset lenders, any out there not using servicing, maybe private lenders, what might be the interest rate, and how would the deal look approximately? Can you provide examples of people who are doing this to help with servicing issues to build?
Yeah, so there's definitely that type of funding. The issue is that in most cases it's not long-term funding. So if you're looking at more like a development deal, or you're looking at a trade, or you're looking at a bridge type situation, we do a truckload of that type of situation, but you're not going to get it from a long-term point of view. So you might be looking at a 12-month loan term where they're completely willing to look at the asset, and there's a lot of it probably under the 55% LVR, that there is options available in the, say, 55 to 70% LVR for better assets, but it's, your pricing is going to go up, and the risk appetite is going to be very much determined by the property, where it is, etc. You talk from a price point of view, big range, property interest rates starting in the mid nines, going well up from there, and the fees can be anywhere from probably 1.5% to well up from there, depending on the client, what they're trying to achieve, etc. as well.
Bernie says, what LVR level would non-bank lenders currently lend to if you have good security and they're only taking one rental asset? It used to be 60 to 70, but it looks like from your slide examples it has moved to 70 to 80%.
Yeah, so just want to differentiate between what I'll call prime non-banks and more the asset lending non-banks that we've just had a quick comment on. Prime non-banks, if you can verify income to a satisfactory level, there are options available up to 80%. Funding lines probably sitting outside the Reserve Bank remit. If you're trying to push to a level but also can't satisfy income criteria, that's going to be a low LVR. So you might be getting capped up at that 65, 70% mark.
Brian says, have you seen any lenders using or accepting a valuation based on the income method, taking net income of a property and applying a capitalisation rate?
This is obviously more the commercial property side of things, and we see clients often where they'll try and do something like a rent by the room type situation and then try and get it valued on a cap rate like a boarding house, but they want to treat it as a residential lend, even though they're trying to play commercial. There's parts of that can be done, but often a lender's still going to look at it and go, they're going to apply a common sense situation to this and go, what is this thing actually worth? So we've seen lots of investors try that over the years where they think they can cap rate it, it goes through the roof, but a lender's not dumb. They know what they know what the property's worth behind the scenes, and what their focus is still going to be if they have to sell the property up, can they get their money back?
Sherry asks, do banks provide interest only if you tell them you can't repay a loan P&I?
So it goes back to, I suppose, what we've been saying on a couple of the examples. We have had situations where the banks have been allowing clients to move to interest only, even though we have shown them. So that the banks are pretty much always, if you're wanting to move on to interest only, they're almost always going to make you go through a full loan application process. The change has been that even though you may not meet the criteria, we have seen situations where the banks have been willing to extend interest-only terms. It is a case of, which part of the bank you're dealing with and what your individual circumstances are. We'd have to put you through a review to see.
And just in closing, a nice comment here from Mac Pang. He says, just wants to thank Kris and I. He met us back in 2008 through Rich Mastery. How amazing you guys are still so active in the field. He still has a revolving credit from his ANZ Flexi since 2008, over $400,000. None of the current banks offer this product anymore, and he still has the same trust set up from me at GRA, thanks to us. So one of our old customers here. Nice to have you. Thanks, Mac. Yeah, it's actually an interesting point that a lot of the structures, we're a structuring firm since the beginning of time, and you're a debt firm. And gee, how many customers have we seen get wealthy through the advice that we've given across the years? I remember 2004 telling one of my customers to go and buy cheap houses in South Auckland for 40 grand. Everybody thought that was terrible advice, and but he believed me, and probably 2002 he bought 40 of them. And,
I was talking to Celeste yesterday, and when I first came on your floor, I was mid to late 20s, and he was early 20s, and we were having a chat yesterday where he said we need to catch up, because he goes, where he suddenly realised a lot of the clients we've dealt with have now got quite wealthy, and we've almost got to do that retirement planning stage, if that makes sense.
Yeah, and I geez, a number of times I've been absolutely savaged online by the anti-property brigade for what I would talk in these webinars about, and call common sense. Things like buying multiple income streams in South Auckland, multiple income stream properties in South Auckland, and you would come in and say, put your deposit down, renovate the property, revalue it, deposit, recycle, start again. In investment circles, that's just standard operating procedure, has been since the beginning of time. Works a treat. You create wealth over the long term. You've got to have a long-term vision. Yet you go online, and some of the people online just think that we're lunatics, and that is the worst advice ever. Yet in our own client bases, we've made people very wealthy, and many of them are retired now. So two perspectives of the same thing. And in this political day and age, actually, property investors are very unpopular for the wealth that they've created using these strategies. But it does work, and I encourage you guys to listen to what we say and do what we suggest, because we've been doing it a long time. It does work.
100%.
Kris, I would just want to thank you for coming on. Kris, excellent as always. Thank you very much. How can our customers online get in touch with you if they want to talk to you?
Yeah, if anyone wants a review, obviously our services, in most cases, are free, except for the time it's trading or development, where occasionally you have to charge a fee. But I suppose a lot of what we kind of covered there is that there are benefits for people understanding how a bank looks at them, and so we can definitely kind of do that service for free and have a chat.
Yep.
And so I suppose website is just krispedersen.co.nz. It's worth me throwing contacts in, or anyone can contact me on 021 300 192. Many people online, I think, we've also dealt with business partner Ryan Smuts, who's helped many of you. Yeah. Very
good. Well, thanks again for coming online. And the next two workshops in this series, I've got David Seymour next up on the 14th of September, and we'll be going over his tax policies, and we're going to go over much wider policies actually. And David's such an articulate guy. He'll wander broadly into any topic with me. It'll be interesting to see how open Nicola Willis and Paul Goldsmith are. I hope they are as open as David is. But you guys are going to get to come after these guys with a stick and ask them your questions and take them to task on policy that you don't like with them or that you would like. And so I look forward to running those sessions. Make sure that you attend those. They should be good fun. And we'll close there. Once again, Kris, thanks very much. Kris is also on our website, GRA's website, so you'll be able to find him through there and connect with him there. We'll see you in a couple of weeks at the next workshop. Thanks, everybody. Good night.